Like I said, the class will be rounding up tonight with currency hedging. On the class tonight, I should have all the students together. Of course, the regular online students and the physical class students joining the class tonight. We have explained the concept of currency hedging. We explained what is exchange rate, direct quote, indirect quote. Please, can we mute? Steven Palandes, please, can you mute? Because your speaker will conflict the class. Ayeni, please, can you mute?
Okay, sir. I'm doing that.
Thank you. We explained the concepts of direct and indirect quotes, how to determine exchange rates. Please watch out for interest rate parity theory. We can use the interest rate between two countries to determine the exchange rate. A country with higher interest rates, we have its currency depreciating faster compared to a country with lower interest rates. We explain this under the interest rate parity theory. We also explain the purchasing power parity theory, that if you know the inflation rates will have impact on the company's currency value. Hence, a country with higher inflation rates, we have its currency depreciating faster. Compared to a country with lower interest rate, we explain this. We look at the currency risk. Under the currency risk, we explain transaction risk, economic risk, and translation risk. Now we look at how to manage or how to minimize the impact of fluctuation in exchange rates. Under this, we explain that we have two groups. We have the internal measures, we have the external measures. Under the internal measures, we discuss leading and lagging, netting, invoice in home currency, do nothing, and matching. We move forward to discuss the external measure. When we get to this external measure, we explain that, or let me re-emphasize that point. 90% of calculation questions on hedging will always come from external measures. 90% of questions involving calculations under currency risk management will always come from external measures. Under the external measures, we have the forward market. That is the forward exchange contracts. Under these contracts, there's a forward rate, a fixed exchange rate, at which there's a fixed exchange rate that is agreed, at which the company will buy or sell currency. Once the exchange rate has been agreed, that rate becomes a binding exchange rate for the future transaction. That means if you are hedging with forward contracts, you know the exchange rates at which you are going to convert currency, foreign currency, at a future period. Regardless of spot rates at that future period, regardless of the spot rate, on the actual transaction date, the forward rate remains binding. We explained this, and we have taken a question relating to forward contracts. We explained the money market, that we can also use money markets to hedge against fluctuation in currency exchange rates by borrowing or lending in the international markets. You can borrow or lend in the international money market with a view to fixing an effective exchange rate now for a future transaction. So you can use money markets to hedge against foreign currency fluctuation. Please note, the forward contracts, the money market hedging, they are binding hedging instruments. Once you hedge, you know the interest rates you are going to use for the future transaction. Now, in order to save time, we did a voice note to support this class. When you get to currency futures is also a binding hedging instrument. These instruments can be used to hedge in the futures market. At this market, two parties agree to buy or sell a particular foreign currency at a particular exchange rate on a particular future date. At this market, the contract are standardized. You can have all contracts are standardized for a fixed amount of money. But the uniqueness of this market, the currency futures market, is that only 7 currencies in the world can operate in the currency futures market. The uniqueness of this market, that is the currency futures market, unlike the forward market, any currency can operate in the forward market. In the money market, any currency in the world can operate. But when you get to currency futures markets, only 7 currencies in the world are recognized. What are these currencies? We have United States dollar, Canadian dollar, Australian dollar, we have British pound sterling, we have yen, we have euro, and we have CHF, Switzerland's currency. These are the 7 currencies that are recognized at the futures market. Also, we have explained the steps if you are hedging with currency futures. We itemized 5 steps. What are these steps? Step number 1 is that you are going to determine the target outcome. What is the company planning to achieve? That is the target outcome. Step number 2, you are going to determine whether to buy or sell futures at the commencement of your hedging. Step number 3, you are going to calculate the number of contracts needed. To calculate number of contracts needed, you are going to take the foreign exposure value divided by the contract size. Number 4, you are going to determine the contract expiring dates to use. The contract expiring date, and your step number 5, you are going to determine the hedge result, the outcome, the actual outcome of your hedging. Now, to determine your hedging results, we explained that you require opening futures price and the closing futures price. To determine your hedge result, you require the opening futures price and the closing futures price. In most cases, examiner will not give you the closing futures price. You now try to estimate the closing futures price. Now, to estimate your closing futures price, you are going to take like 3 steps. You are going to calculate the basis. Your basis is calculated as spot price minus the opening futures price. When you get your basis, you are going to separate the basis into expired and unexpired basis. When you are done with this, you now move to the 3rd stage. The 3rd stage is to calculate your closing futures price. Your closing futures price is calculated as the opening futures price plus unexpired basis. Now, once you estimate your closing futures price, the estimated closing futures price becomes the locked-in exchange rate. That is the exchange rate at which the foreign transactions will be translated or converted. We explained this. We now move to currency options. Currency options. Currency options. Unlike the 3 we have explained, currency options is an option, a right, but not the obligation to buy or sell a specified amount of foreign currency. Currency options, unlike the 3 we have explained, is an option, that is a right to buy or sell a specified amount of foreign currency at a predetermined exchange rate. The predetermined exchange rate is the exercise rate within a specified future period or on a particular future date. Currency options can be used to protect a company against adverse movement in exchange rate. At the same time, it allows the company to take advantage of favorable movement in exchange rates. You can take advantage. Now, because of these benefits, currency options is more expensive as an hedging tool than other hedging methods. We explain this. We equally explain the fact that there are two variants. There are 2 types of currency options. We have, excuse me, please. We have over-the-counter currency options. For over-the-counter currency options, it's more like forward contracts in that it is available in all currencies. Then it can be designed to meet the precise requirements of the clients, meaning that it can accommodate any amount of contracts. It can accommodate fractions. We explain this. We equally explain the second variant, exchange traded currency option. Exchange traded currency option has some similarity with futures contracts in that it only recognizes 7 currencies. We are talking of exchange traded currency options. Only 7 currencies are recognized in this market. What are these currencies? The 7 currencies: United States dollar, Canadian dollar, American dollar, British pound sterling, euro, yen, and Switzerland currency. And the contract is for a limited forward time period. Most contracts are for 3-month period. Okay, we now look at the steps. If you are hedging with exchange traded currency options, what are these steps? The first thing is you are going to answer the questions. Do we require call or put options? This must be addressed. Am I going to hedge with call option or put option? Remember, call option, right to buy, and put option, right to sell. Then you are going to calculate number of contracts. Okay, let me add at this point. If you are calculating number of contracts, there is no room for fractional contracts. We can only accommodate whole number. So if the question is taking you to fractions, there is a way to deal with the fractional aspects, which we plan to do tonight. Then you are going to determine the contract expiring dates to use. You are going to determine the exercise price to use. Then you are going to calculate the premium payable. Finally, the last step is that on the actual transaction date, you are going to compare the exercise price with the actual spot price. I will say that again. On the actual transaction date, you are going to compare the exercise rate with the actual spot rate to determine whether to exercise your rights or not. Where the actual spot rate is not given, where the examiner does not provide the actual spot price, then you are going to assume that the option will be exercised at the exercise price. These are the steps involved. And lastly, we talk about currency swap. Currency swap, like we explained, currency swap is a contractual agreement between 2 parties to exchange principal amount of loan and interest in one currency for another principal amount of loan and interest in another currency. I'll take that again. Currency swap is a contractual agreement between 2 parties to exchange the principal amount of loan and interest in one currency for another principal amount of loan and interest in another currency. The objective is to protect the company against foreign currency fluctuation. For example, like we mentioned, the example we gave, I should round up in 3 minutes. We have a company in Nigeria, Bank of Industry. Bank of Industry obtained loan from World Bank in dollars. Assuming the loan is $100 million. Now, Bank of Industry is expected to repay this loan in 2 years. Now, Bank of Industry is disturbed about exchange rate volatility. Naira will fluctuate regularly against dollar. Now, Bank of Industry is now trying to protect itself against foreign currency risk. Bank of Industry can approach Central Bank of Nigeria to go into currency swap. Now, Bank of Industry can approach CBN. Under currency swap, Bank of Industry will transfer dollar loan to CBN. It will now obtain Naira loan from CBN. That means the two parties are swap currency. The loan in dollars has been transferred to CBN. CBN will now return Naira loan to Bank of Industry. When it is time for repayments, Bank of Industry will pay Naira loan to CBN. CBN will pay dollar loan to World Bank. That is the concept of currency swap. Under currency swap, you can also have exchange rate swap. There could be exchange rate swap, whereby a swap rate is agreed to, where currency will be swapped at the commencement of hedging. A particular currency, look at it here. We call it forex swap, foreign exchange swap. Under forex swap, the parties agree to swap equivalent amount of currency for a period, and then to reswap them at the end of the period at an agreed swap rate. The swap rate and the amount of currency is agreed between the parties in advance, so you can have exchange rate swap. For example, our company based in Nigeria, we plan to place investment in US for 2 years. Definitely for our company to place investment in US, we need to convert our Naira to dollar. At the end of the investment period, we are going to get our initial investment and return in dollars. We need to also convert back to Naira. We can go into exchange rate swap, whereby we are going to agree a swap rate at which we convert Naira to dollar today. We now place the investment. After 1 year, 2 years, when we repatriate our investment amount, we are going to reswap back at the same swap rate agreed today. That is the concept of forex swap. It is very similar to forward rate. The only difference is that while forward rate is used for short-term transactions, if you look at forward rate, we use forward rate of, if you look at forward contract is for a short-term foreign transaction of 3 months, 6 months. But if you are looking at a longer term foreign transactions, then we are going to go to currency swap. We are not going to have a swap rate. All right. All right, let's move to question. We have limited time. Now I will be taking question number 4. We have addressed question 1 in our class. Please let us go to question 4. Question 4 is more involving. There are some concepts I want to explain. Like I said, we adjusted this question to accommodate some certain principle or technique we want to explain tonight. So if you are seeing the adjustment, please, we are going to work with the adjustment. All right, thank you. Question number 4. About 1 year ago, you were employed by Tesco, an American company in the New York. You work online from home in Nigeria, and you are a member of the International Treasury of Tesco. Tesco supplies medical equipment to the US and Europe. It also buys basic raw materials from Europe. It is currently 30 November 2014. On 31st May 2022, Tesco is due to receive CHF 16.3 million from a Swiss customer. Also, to pay 4 million CHF to a Swiss supplier. Exchange rate information. We have the spot rate. Exchange rate quoted United States dollar /1 CHF. Macroeconomic information. The country US, Switzerland, annual inflation rate in US, inflation rate in Switzerland, annual risk-free rate in US, also in Switzerland given, tax rates given in the 2 countries. Next, annual interest rate available to Tesco, the investment rates and borrowing rates. Okay. Currency futures, we have the contract size, futures price quoted in United States dollar per CHF1. Futures price, we have December futures, we have March futures, and we are giving June futures. Currency options, we have the contract size given to us. We are giving exercise price also. Requirements. Advise Tesco showing relevant calculations. Which of the underlisted hedging strategies the company should adopt for its CHF cash flow on 31st May 2025? We have the forward contracts, money markets, traded futures, traded options. In the case of options, assume the options are exercised. Remember what I said, where you are not giving the actual spot trades. Another examiners make this very clear. We are going to assume that the options will be exercised. Note, any amounts not hedged by futures or options contracts will be hedged under the forward market. Now, unlike the question we solved last week, if you look at the question we solved last week, even in my physical class, the question we solved, examiner gave us the forward rates. The question we solved last week, we are giving the forward rates. In this question, we are not giving the forward rates. Deliberately, we remove the forward rates. We want to use this question to explain, assuming you are not giving the forward rates, and you are required to hedge using forward contracts, then the examiner must give information. Information about inflation or information about risk-free rates. I'll repeat that. Unlike all the questions we have solved, the question we solved under hedging, for those in class last week, we solved question 1. And in that question, examiner gave us the forward rates. So we just pick the forward rate and use it. What happened in exam? That examiner wants you to hedge using forward contracts, and you are not giving the forward rates. How do you go about estimating the forward rates? All right, enough of explanation. Let us go to the whiteboard. Please get your writing pad closer to you. Let us assume we are in the physical class, and please get your calculator closer to you. All right. Now, like I usually explain, if you are dealing with question on hedging, please start with your analysis. We have the International Treasury in New York. The Treasury Department is located in US, based in US. Based in USA, therefore, United States dollar is the domestic currency here. Then we have transaction in Switzerland. We have transactions In Swiss, the currency is CHF. Therefore, this is the foreign currency. Please, can we mute? Can you mute your speaker, please? Now go to the exchange rate information. Examiner says United States dollar / CHF 1. Look at the exchange rate information the examiner has given us. United States dollar per 1 CHF. What type of quotation is this, please? If you look at it, domestic currency per 1 foreign currency. This is a direct quote. Direct quote. The spot rate we pick. Spot rates. $1.0292 to $1.0309. Pick your spot rates. 1.0292 to 1.0309. We are giving this. We have determined the type of quote, direct quote. Now we move forward. We have examiner say currently, today is 30 November 2024. We now have transaction on the transaction we have, the transaction dates, the transaction date is 31st May 2025. Please, how many months is this?
Six months.
Thank you. That means we have 2 transactions that will happen in 6 months. In 6 months' time, we have 2 transactions. Expected receipts. Expected receipts in CHF, if you look at it, 16,300,000. Expected payments. Also 6 months. 4 million rand. Like we explained, where you have 2 transactions in the same currency and the same future period, what you are expected to do is to net off. When you net off CHF, this will give you 12,300,000. This is the amount we are going to now hedge. Now, we have assumed that we are not giving the forward risk. So in the question, it was given, but we deleted it. We want to explain how you can calculate the forward rate yourself. Now, if you go to the question, examiner gave us inflation rate. Inflation rate in US, 2.4%. Inflation rate in Swiss, 0.8%. And we know the spot rate. We know the spot rate. We can use this information to estimate forward rate between the 2 currencies. Let's go to that place. Now I want to hedge with forward market. Strategy 1. Forward contracts. We now come here using purchasing power parity theory. Remember, we are giving direct quotes. The formula for direct quote, we have 1 plus Fi over 1 plus Di is equal to X over F, where your Fi is inflation, your Fi is foreign inflation. Your Di is domestic inflation. Our S is the spot rate, and our F is the forward rate. We are now trying to determine the forward rate. Let's go to this place. Annual inflation in US is 2.4, but we want to determine the forward rate for 6 months because this transaction will happen in 6 months. Now come here, get 6 months rate for US, 6 month rate for US. That becomes 6 over 12 multiplied by 2.4%. That will give us 1.2%. Also, go to CHF, 6 month rate, 6 over 12 multiplied by 0.8. Please compute what we have. I think we should have like 0.4, if I'm not mistaken. Is that correct, please? This should be correct.
Yes, sir.
Good. Now remember that we have determined the foreign inflation. CHF is the foreign currency. That means the foreign inflation is CHF. Domestic inflation is US. So if you come to, okay, before that, the spot rates. Okay, good. Look at the spot rates. We are, of course, examiner must give you two rates. We have the lower rates and the higher rates. You now ask yourself, which rate are we going to use? The first rate or the second rate? The lower rate or the higher rate? You now try to determine the buyer and the seller. You are going to try to determine the buyer and the seller. Now, we are expecting a net receipt. A net receipt of 12.3 million CHF. Our company is based in US. We are expecting a net receipt of 12.3 million. If you get the money, that means we are going to approach our bank. We are going to be selling. Bank will buy. That means for this transaction, the customer is the seller, bank is the buyer. Now the question is, given a direct quotation, at what rate will the bank buy?
Lower rate.
Given a
higher rate.
yes, please.
Higher
Lower
rate.
rate. Why? Given a direct quotation, at what rate will the bank buy?
The higher rate, because according to the note, it said for a direct quote, the bank buys at a higher rate and then the bank sells at the bank buys at lower rate and then sells at higher rate. So they'll be buying at lower rate.
So you are correcting yourself, right?
Yes, sir. They are buying at a lower rate and then selling.
Now, bank will buy at the lower rate. Bank will buy at 1.0292. So that is the spot rate we are going to use. You now come here, look at it. Our spot rate. The X is 1.0292. What is F? We don't know yet. I cannot come here, please. Look at the formula. 1 plus foreign inflation. Foreign inflation is 0.14%. Over 1 plus domestic inflation, 1.02%, is equal to spot rate, 1.0292. What is F, please? You can now forecast forward rate for 6 months. Please, let's work this out. What is F?
Is that like?
Please, can you mute? This becomes, let me spell this out for us. This will give you 1 plus 0.004 over
1.0374.
final answer.
1.0374.
Oh, great. Thank you so much. So you can work this. Somebody has confirmed the answer to be 1 point what, please? 1.0374.
374.
This is the 6-month forward rate. This is the 6-month forward. That means 6 months time forward rate. The forward rate between United States dollar will be 1.034 to 1 CHF in 6 months time. We have just used this to explain 6 months. 6 months forward rates. You have estimated the rate, and this is the rate that will be used for this transaction. I want to take this off. This is the rate for this transaction, 6 months forward rate. We have estimated. Now, we now determine we are expecting in 6 months, we are expecting CHF 12,300,000. We now want to convert, CHF to dollar at this rate of 1.0374. Are we going to multiply or divide? Please note, if you are giving direct quotes and you want to convert foreign currency to your domestic currency, in this question, our domestic currency is dollars. The foreign currency is CHF. We now want to convert foreign currency to domestic currency. You are going to multiply by the rate. You are going to multiply. We now multiply by 1.0374. This will give us the dollar equivalent we are expecting. Please multiply.
12,760,020 naira.
12,760,020.
020.
This is the dollar the company will receive in 6 months' time. If the company hedge with forward market, and this amount is binding, once you hedge with forward market, that means we are done with strategy 1. We are done with what? Strategy 1. Strategy 2, the money market hedge. Let's go to this money market hedge. The money markets. If you are hedging with money markets, it is better to approach your hedging using steps. Remember, we are expecting expected receipts. Expected receipts. Our company based in US, we are expecting CHF 12,300,000. Now to hedge, my step 1. Now, the expected receipt is an asset to my company. My company is based in US. We are expecting inflows, a receipt of 12.3 million CHF. That means that transaction to my company in US is an asset. We have a foreign asset. For me to hedge with money market, create an equivalent foreign liability. You are going to do the opposite. I'm expecting receipts. That receipt is an asset to me. So I will create an equivalent foreign liability. My step one, create equivalent foreign liability. What that means is that I'm going to borrow an amount in CHF. I'm going to borrow an amount in CHF. The amount I'm going to borrow plus the interest payable on my borrowing must equal to the amount I'm expecting in 6 months' time. I will take that again. Create an equivalent liability. That means borrow an amount in CHF. Look at it, i.e., borrow an amount in CHF now. Full stop. The amount borrowed plus the interest payable plus interest payable must equal CHF 12,300,000. That will be your step one. You now go to step two. Calculate the amount borrowed or to be borrowed now. To be borrowed now. We now go to the question. What is the borrowing rate in Switzerland? Go and look at the interest rates. Look at it, please. This is borrowing rate in Switzerland. Annual borrowing rate is 4.4. But we want to borrow for 6 months. So I will calculate 6-month borrowing rates. I will come here. Six months borrowing rates in CHF is equal to 6/12 multiplied by 4.4%. That will give you 2.2%. This is the 6-month borrowing rate. Therefore, amount to be borrowed. Therefore, amount to borrow is equal to, look at it, the target amount. The target amount is 12,300,000 divided by 1 plus the borrowing rate, 6-month borrowing rate, 2.2%, 0.022. Please determine the amounts the company will borrow now. Please determine the amount the company will borrow now. What do you have, please? The amount to be borrowed now, 12 million, 035.
225.05.
You can ignore the points.
Okay.
This is the amount we are going to borrow now. You now move to your step 3. Move to your step 3. Convert the amount borrowed to your domestic currency. In this case, our domestic currency is dollar. Your domestic currency. In brackets, dollar. Using the spot rates. Of course, we assume that the company has borrowed the money. That means the company has the cash with them. The company has borrowed, our company based in US, we have borrowed in CHF. We have the cash with us now. We now want to convert to Naira. Sorry, we want to convert to dollar. We are going to approach the currency dealer. We are going to sell, bank will buy. That means bank will buy at the lower spot rate. The lower spot rate is 1.0292. So if you want to convert the dollar amount, is equal to 12,035,225. Of course, under indirect quotes, you are going to multiply to convert to domestic currency. Multiply by 1.0292. That will give you the dollar amount. You convert the CHF to dollar.
12 million.
12 million.
386.
386.
654.
654. So you have converted to your own domestic currency. Your step 4. Your step 4 now, you are going to invest this amount in your own domestic money market. In this case, US money market. The step 4. Step 4. Invest the dollar amount for 6 months. 6 months in USA. You now go back to the question. What is the investment rate in US? Look at it, please. Investment rate in US is 4.6%. That is the annual investment rate. But we are going to invest for 6 months. So we need to calculate 6 months investment rates. This is equal to 6/12 multiplied by 4.6%. That will give you 2.3%. So we are going to invest 12,386,654 for 6 months at the rate of 2.3. So what is the expected amount? Expected dollar amount in 6 months. That will equal to, look at it, we are going to invest 12,386,654 for 6 months at the rate of 2.3, multiplied by 1 plus the investment rate, 0.023. That will give you the expected dollar amount in 6 months. What do you have, please?
12,671,547.
671 547. You may stop here. This is that means if we hedge with money market, this is the amount we are going to get in 6 months. By the time we get our 12,300,000 CHF, we now want to convert to dollar. This is the amount we are going to get in dollars. But you can also round up with step 5. Look at it. The step 5. Step 5. In 6 months' time, when the company receive the expected inflows, of 12,300,000, this will be used to repay the foreign borrowing and the interest elements. Full stop. Next. The company can now liquidate the local investments to receive in dollars 12,671,671,45 what self?
457.
547.
457.
Is it 4?
547.
547. This is the end of your money market hedging. This is the end of your money market hedging. The question we solved last week, the question dealt with forward markets and money market hedging. The question we have solved so far now is also looking at forward markets and money market hedging. Now we want to move to traded futures. Number 3 hedging strategy. Traded futures. It's also called currency futures. Let us open a new white. Ready to number 2. Let's take a new whiteboard. Yes, Joshua.
Excuse me, sir. Hope we are going to get the worksheets after the class.
Of course.
Okay, sir. Thanks.
That one is, I just don't want to occupy this place too much. Let me take a new whiteboard. Now, traded futures or please in the exam, just try to master the steps. Strategy 3. Traded futures. Step 1. Determine the target outcome. Determine the target outcome. Now, what is the target outcome? You now ask yourself, assuming we receive the money today, we know that the money is coming in 6 months. Our company based in US, we are expecting inflows in 6 months' time. You are now going to assume that, the company received the money today. Assuming our company received this money today, what will be the dollar amount? What is the dollar equivalent if we receive the money today? That is what we are targeting to achieve. Look at this. The target outcome, target outcome. Assuming we receive the CHF 12,300,000 today, we are going to convert this using the spot rate. We are going to approach our bank. We are going to be selling CHF. Bank will buy CHF. That means bank will buy at the lower rate. The lower rate is for spot rate. The lower spot rate is 1.0292. This will give you the target outcome. Please multiply.
12,659,160.
In dollars. Next.
659.
659.
160.
160. These are our target outcome. Meaning that our target is if you receive this money in 6 months' time and we convert to Naira, then we must not receive less than 12,659,160. No matter how the currency fluctuates, we must not receive less than this. Because the purpose of hedging is to protect yourself against fluctuation in exchange rates. So the target outcome is we must make sure that if we get the money in 6 months and we convert this money to dollar, if you get the CHF in 6 months and we convert to dollar, then we must not receive less than 12,659,160. If you receive more, we are better off. But we must not receive less. This will be your step one. We now go to step two. Step two. Determine whether to buy or sell futures. Determine whether to buy or sell futures. You must answer this question. Now, to answer this question, you now try to explain to yourself. Our company based in US, we are expecting inflows in CHF. When we get the inflows, we need to convert it to dollars. That means when we get the inflows, we are going to be selling CHF. Bank will buy from us. So to answer this question, you are going to say the company will sell. I want to move this off, please. No, it's too much. To answer this question, now come here and say, the company based in US now, the company will sell CHF futures. Now, that is at the commencement of the hedging, the company will sell CHF futures. It is important to state this fact. We move to step 3. Calculate number of contracts needed. Calculate number of contracts needed. The number of contracts needed is calculated as your exposure value, the foreign exposure value, divided by the contract size. By the contract size. Our exposure value, how much are we expecting in 6 months' time? We are expecting, that's the exposure. We are expecting 12,300,000 divided by, now go to the question. Under futures market, look at here, please. Currency futures, contract size, CHF 125. That is the contract size. So pick your contract size, divided by the contract size, CHF 125. Please calculate number of contracts, please.
98.98.
You didn't complete it.
98.
You have
98.4.
98.4. Now, under currency futures.
Sorry, sir.
Yes, ma'am.
Please, I have a question.
Please go ahead.
when you started this strategy 3 traded futures, you said the target outcome is the outcome to be expected in 6 months time, if I'm correct.
Okay, go ahead.
So now we are calculating the number of contracts needed, and the exposure value we are using is still the 12,300,000. I'm kind of confused. I actually thought we were going to use the 12,659,160.
Okay, please throw away the thoughts. Your
Okay, sir.
exposure, when you say exposure, your exposure is in foreign currency. If it is in dollar, you don't have any risk because you are based in US.
Okay.
Do you understand it?
Yes, sir.
Remember that the purpose of your hedging is because you are afraid of currency fluctuation.
Yes,
You
sir.
are based in US. You are expecting money from Switzerland. That means Switzerland currency is foreign to you. If you
Yes,
get the
sir.
money in 6 months, you are afraid that if you convert to your own currency, dollar, it might fluctuate negatively. You now first, your step 1, determine what you target to achieve. What you are targeting to achieve is you are afraid of fluctuation in exchange rates. Assuming you receive your money immediately, you convert to dollar, you don't have any risk. But you are going to receive the money in 6 months. And say, okay, wait. You now assume in step 1 that assuming I have gotten the money today, then the dollar equivalent will have been 12,659,160. Assuming I receive the money today, the dollar equivalent will have been 12,659,160. Now, you now want to make sure that when you receive the money in 6 months and you convert, the dollar amount should not be less than 12,659,160. Do you understand it now?
Yes, sir. Yes, sir. Thanks, sir.
You know, if it is more, you'll be happy.
Yes, sir.
But your problem, your concern that this money should not be less. If the money is more, you'll be happy. It's okay now. I'm making more money.
Yeah.
The same thing the company will feel that. So if you get to your number of contracts, you are going to take the exposure. Your exposure is in foreign currency. Divide it by the contract size. Okay. Now, if you look at the contract size, we have fractions. And in this market, there is no room for fractional contracts. It can only accommodate whole number. Unlike the question we solved last week, when we calculated the contract size, okay, we solved that question last week. No. Not on the online class. Now, we now have a situation here. We have fraction. Under the traded futures, we can only accommodate whole number. So you are going to take 98 contracts. You are now going to say 98 futures contracts. That means we have some fractions that is not covered under futures contracts. We have some fractions not covered. Now come here. Hedge amount. Look at please under futures. Futures hedge amount. Because we have selected 98 contracts, and one contract is for 125, contract size. One size is 125. Now, please multiply 98 by 125,000. What is the amount, please? You are going to get in CHF 12,250,000 if you work that out.
Yes.
Good. But look at your exposure. Your exposure is in CHF, your exposure is 12,300,000. That means on edge, look at it, on edge amounts. On edge amounts. On edge amounts. Oh, sorry, I want to take this. On edge amounts. Out of 12,300,000, we have edged 12,250,000. That means we have in CHF, we have 50,000 cannot be hedged under futures market. Examiner now says something. Examiner says, oh, where's my? If you look at the last note, examiner says something here. Note, any amount not hedged by futures, by a future or option contract will be hedged on the forward market. Look at that statement. Examiner is aware that you are going to have fractions when you get to currency futures. And currency futures do not accommodate fractions. We are now going to select O number. Now, any portion not hedged under currency futures will be taken to hedge under forward market. That means this 50,000 CHF this amount will be hedged. I will now do like this. Look at it. This amount, come here, under forward market, we are going to hedge the balance of CHF 50,000. Out of this 12,300,000, we have hedged 12,250,000 under currency futures. We now take the balance because this balance cannot be hedged under futures. It is not up to 125,000. This 50,000 will now be hedged under forward market. Remember the forward rate. The 6 month forward rate will be computed. If you remember, the 6 month forward rate we computed, we got 1.0374. That means we are going to convert this 50,000 CHF using the forward rate. That is, it is hedged under forward. If you convert this, what is the dollar equivalent, please?
51,870.
51.
51, yeah.
870, are you sure?
Yes.
620.
51,8. Have you? Yeah.
Is correct.
Okay, 51. Oh, 51,870. Okay, I need to put dollar here, please. This is equal to dollar amount 51,870. Okay. So please watch out if you have fractions. If you don't have fractions, no problem. Assuming you have gotten 98 whole number, no problem. But when you have fraction, know how to deal with your fraction. Also, please watch out. You can forecast the forward rate. Examiner may deliberately give you a question. He will not give you the forward rate. Examiner will not give you the inflation rate and the spot rate. So you must know how to forecast the rate. Now, this will happen in our step 3. Our step 4. Our step 4. Step 4. Determine the contract expiring dates to use. Determine the contract expiring dates to use. Expiring dates to use. Now, to work this out or to determine this, you are going to ask yourself, when are we expecting the inflows? We are expecting the inflows on the 31st May 2025. Examiner says, assume today is 30th November 2024. Then the company is expecting transactions in Swiss on 31st May 2025. Now we now go to the question. Under futures, you are giving contract for December. You are giving contract for March. You are giving contract for June. Now, to determine the appropriate expiring date contract to use, the appropriate expiring contract to use is that contract that will mature after the transaction date. That contract that will mature immediately after the transaction date. The transaction date is on 31st May 2025. That means after May, I have June. After May, I have June. It is this contract that will mature after the transaction, immediately after the transaction date. So the appropriate contract to select is the June contract, June expiring date contract. You now state this fact to the examiner, and you are giving a price 1.0369. Now come here. The company we select June expiring contracts. There's a price attached to that June with opening futures price of 1.0369. You are going to put the price that is attached to that particular contract you have selected. Is that clear, please? So you are going to look at the transaction date. The transaction date is given in this question. Examiner says transaction will happen. Look at it, please. Transaction will happen. Look at it. On 31st May 2025. Tesco is due to receive CHF 16.3 million. You now ask yourself, which contract will mature after May? Which contract mature immediately after May? We now say, okay, we cannot select March contracts, but June contracts will mature after May. You now select it and pick the price attached to it. Now, please note, that price attached to that contract is the opening futures price. This is the opening futures price for June. This is the opening futures price for March. This is the opening futures price for December. So my appropriate contract is June contract. When you are done with this, you now move to your step 5. Your step 5 is to determine the hedge results. Determine the result of your hedging. Determine the hedge results. Now, for you to determine your hedge results, for you to be able to determine your hedge results, you require the opening futures price and the closing futures price. I will say that again. For you to be able to determine your hedge results, you require the opening futures price and the closing futures price. Examiner will always give you the opening futures price. The examiner will always give you the opening futures price. The examiner will always give you the opening futures price. But the examiner will hardly give you the closing futures price. Examiner will hardly provide the closing futures price for you. Like the question we are solving now, there's no closing futures price. In this case, you are going to estimate your closing futures price. In this case, you are going to estimate your closing futures price. Now, how do we estimate closing futures price? You have like 3 steps or 3 stages. The first thing to do, look at it. First, calculate your basis. Your basis is calculated as spot price minus opening futures price. Your spot price means the spot exchange rate. If you look at the spot exchange rate, if you go to step 1, the spot rate we use is 1.0292 minus opening futures price 1.0369. Please work this out. You have negative negative 0.0077. This is your basis. When you are done with the basis, now separate the basis into expired and unexpired. Separate the basis into expired basis, unexpired basis. How do we separate this? Remember, today is 30 November 2014. And we have selected a contract of June. Now, count between November to June. How many months, please? November to June. November 30th to ending June. How many months?
Months.
How many months?
7 months.
That should be 7 months. That means the contract will run for 7 months. But our transaction will happen in 6 months. We are going to receive the net receipts in 6 months. But we have selected 7 months contract. Now, that first 6 months, from month 1 to month 6, is known as expired basis. Look at it, please. Month 1 to 6. If I want to calculate the first 6 months, 6/7 multiplied by negative 0.0077. That will give me the expired basis. After the transaction has happened, our contract at the futures market will still run for 1 month because it's for 7 months. Then 1/7 is the unexpired basis. 1/7 multiplied by negative 0.0077. If you work this out, our major concern is the unexpired basis. We have just shown the two to explain. But what we needed more is the unexpired basis. If you calculate the unexpired basis, that will give you Sorry, I'm trying to pick this pen. This will give us negative 0.0011. This is the unexpired basis. Then you can now calculate your closing futures price. The closing futures price, is equal to opening futures price plus unexpired basis. So if I go down a bit, I'll just come here. My closing futures price is equal to opening futures price 1.0369 plus bracket unexpired basis minus 0.0011. Because of this power of minus, so this will give me 1.0369 minus 0.0011. This will give you your closing futures price. If you work this out, this will give you your closing futures price. What do you have, please?
$1.0358.
This is the closing futures price, estimated closing futures price. And please note, once you estimate the closing futures price, that becomes your lock-in exchange rate. That is the lock-in exchange rate, 1.0358. When we say lock-in exchange rate, that is the binding rate for that transaction. That means the edge will be converted at that rate. So the final answer for this, look at it, please. Remember that under currency futures, we only hedge 12,250,000. Look at it, please. Futures hedge amounts. We hedge CHF 12,250,000 under futures. This will be converted at the rate of 1.0358. That will give you the dollar for that amount. Please convert for that amount. The dollar amount. What do you have?
12,688,550.
12,688,550.
550.
550, Abby?
550.
$550. But remember, we also have amounts hedged under forward contracts. Forward contracts. Amounts. Remember, we have a differential of 50,000, Abby? And we use 1.0374. That gave us 51,870. So we can now calculate total dollars. If we hedge under currency futures, total dollars amount we are going to get 12,688,550 plus 51,870. This will give us 12,740,420. Is that not, please? This is the amount the company will get in 6 months in dollars. 12,740,420. Look at it. The tag, and if you look at the targets, our target is we must not get less than 12,659,160. So at the end of the aging, the company will get 12,740,420. That means the age is fine. It's good for the company. Now, please note, if you compute in the exam and you got less than your target amount, that means there's error in your calculation. Let me repeat my points. The expected receipt is under receipt. Our target is to get 12,659,160. If you compute in step 5 and you receive less than 12,659,000, you can receive more than under receipt. But if you receive less, that means you have a problem in your calculation, because you're already trying to protect yourself. All right. I know the question will take time. I have just 30 minutes. The last aspect is traded options. The last aspect is traded options. Strategy 4. Traded options. Now, quickly, remember that we have 2 types of currency options: over-the-counter currency options and exchange-traded currency options. Now, how do we differentiate? Which one is the examiner text in here? For over-the-counter currency options, the question is always direct. But if you want to know the one the examiner is texting, when it comes to exchange traded currency option, examiner will specify the contract size. Look at this, under currency option, there's a contract size attached to it. That is a sufficient evidence that the examiner is texting exchange traded currency options. Now, what are the steps involved? What are the steps involved? Please, let's look at the steps. Step 1. Do we need call or put option? You have to answer this question. Are we going to hedge with call option or are we going to hedge with put option? Now, to answer this question, our company based in US, we are expecting inflows in CHF. When we get this money, normally when we get this money, we are going to be selling to bank. That means we need to obtain a right to be able to sell CHF. Now, what is the right to sell under option theory? The right to sell is the put option. So you are going to state this fact: the company requires a put option. A put option to hedge the exposure. To hedge the exposure this statement or this response will award you mark. Then go to step 2. Determine or calculate number of contract needed. Calculate number of contracts. The same thing we did under currency futures. Exposure. Our exposure is in CHF, 12,300,000, divided by the contract size. That means we are going to have 98.4. But under currency options, exchange traded, there's no room for fraction. So we are going to now say 98. We are going to select 98 option contracts. That means there's a fraction. The same thing we did under currency future, we apply here also. That means we have only hedged, look at this, we have only hedged the hedge amount under futures. The hedge amount is 98 contract multiplied by one contract is for 125,000. That means what we have hedged is in CHF, we have only hedged 250,000. The balance will be hedged under On edge amount, you state the fact also. On edge amount, the on edge amount CHF is 50,000 to be hedged under forward market. To be hedged under forward markets. I'm doing this to also explain it. Under forward markets. You have set to your step 2. Your step 3. Determine the contract expiring date to use. My step 3. Contract expiring dates. Expiring dates to use. Question mark. This transaction will happen on 31st May. So the appropriate contract to use is that contract that expired after May. If you go to the option market, look at the option market. We have December contract under put, December contract, March contract, June contract. The appropriate contract to select is June. The company will use June option contract. Exercise price, we are giving just one exercise price. Exercise price. The exercise price is giving us 1.0375. 1.0375. And the premium. What is the premium for June under put option? Remember, we have selected in our step 1, the company requires put options. It is important to determine the appropriate contracts, to determine the appropriate expiring dates. Examiner will give you different rates for different dates and for different contracts. Now we have selected put options. And under the put options, we are taking June. This is the premium. This is the exercise price, 1.0375. This is the premium element. Now look at it, please. Look at the premium. The premium is giving United US cents per CHF. So if you go to our working, the premium, oh, sorry, it's moving so fast. No, no. Okay, the premium, United States cents per CHF1. Examiner, this is equal to 0.86. Our step 4, select the exercise price. In this particular question, we are just giving one exercise price. So we select it. Come here, step 4. Exercise price. Exercise price. 1.0375. Next, our step 5. We are supposed to compare the exercise price with the actual spot rate in 6 months on the transaction date. Transaction date is 6 months. But in this question, we are not giving the actual spot price in 6 months' time. Examiner even says that we should assume that the option will be exercised. Look at it, please. In case of the options, assume the options are exercised. You now come here. It is assumed that the options are exercised. At exercise price of 1.0375. Therefore, the dollar amount, therefore, expected dollar under traded option. Traded option is equal to, remember that under traded options, we only had CHF 12,250,000. We selected 98 contracts. So this is the amount under trade option. We now convert at exercise rate, multiply by 1.0375. What is the dollar amount, please? Dollar amount, please.
$12,709,375.
12,709. 3 what?
375.
375. This is the dollar amount the company will get under traded options. Then remember, we have some portion hedge under forward markets. Expected dollar under forward markets. Under forward markets. Remember, we have 50,000. This will be converted at 1.0374. Is that not? That will give us 51,870. The same thing that happens under traded futures. You can now add these two together. What do we have, please?
Twelve 761.
12,
245.
7, 6, 1.
Yeah. 245.
2, 4, 5. Then the final aspect, premium calculation. Under currency options, you are going to pay premium. The premium payable. To calculate your premium, please look at it. To calculate your premium is equal to number of contracts, 98. Number of contracts multiplied by the contract size. The contract size is 125,000. Then multiply by the premium given to you. Look at the premium. Examiner says United States US cents per CHF 0.86. You need to be careful here. This is given to you in cents, just like saying in kobo. If you now want to convert kobo to naira, you need to divide this by 100. Cents is an equivalent of Nigerian kobo. So what we have here is like saying I have 0.86 kobo. If I want to take it to naira, I need to divide it by 100. That means this 0.86. For me to multiply it, I'll first of all take it to naira. I'll divide it by 100. I'm converting cents to dollar. That will now give me dollars. Multiply by, that is in dollar now, 0.0086. This will now give us the premium payable now in dollars. If you work that out, you are going to have 105,350,000. This is a premium, it's a cost. You can now get your net amount because you must pay, out of this, you must pay premium. Expected net receipt in dollars. Expected net receipts in dollars. Final answer, please. Net this off here. 12 million. What's the final answer, please?
655. 12,655,895.
55,895. You are done with your aging. You are done with the 4. You can now recommend. Now your recommendation. Reasonably, with under receipts, whichever method is giving us the highest dollar receipt will be the best option for us. So if you want to do a summary, because we are talking of receipts, if you want to do a summary, summary of results. We have forward market or forward contracts. How much is the dollar equivalent that we are going to get if you hedge here? We have money market. How much are we going to get in dollars? Remember, our company is based in US. We have traded futures. Traded futures. How much are we getting in dollars? Then we have traded options. Traded options. Under traded options, we are going to get 12,655. 895. Under traded futures, how much are we getting? Let me check. We are going to get 12,740,420. $12,740,420. Let's check the first two working we did. Under money market, we are going to get 12,671,547. 671,547. 12,671,547. Then under forward contract, how much are we getting? Under forward contract, we shall be getting, look at it here, 12,760,020. 12,760,020. Now, if you compare, which of the hedging strategy will give the company the highest dollar receipts in 6 months?
Forward contract.
Thank you. Forward contract will give the company the highest dollar receipts. That means if you are going to recommend to the company should hedge using forward exchange contracts. The company should hedge the 6-month expected receipts using the forward exchange contract because it gives the company the highest dollar receipts. We have come to the end of this question, and of course to the end of the lecture tonight, and by extension the end of our lecture for this diet. No doubt the exam is very close. we have spent considerable time trying to take this topic. Please, let us try to review our material. Your exam, in fairness, in very fairness to us, we all have a chance of writing this exam and doing very well in this exam. Please go to that exam and try to review your notes very well. Part of what you have solved in class, whether directly or impliedly, will be in your exam. You can, to some extent, we can predict the pattern of what is likely to happen, although nobody can speak to it 100%. But based on your syllabus said your 15 marks will be taken from the first 3 chapters. If you go to ICANN Study Pack, you have Introduction to Strategic Financial Management. You have the issues like agency concepts, duties of directors, treasury functions, the function of finance manager. Then we talk about regulatory environments, issues like EFCC issues, regulators, financial regulators. Examiner says out of this, agency concept, okay, issue of shareholder concepts, stakeholder concepts, conflicts. Examiner says 15 marks will be texted from here. That means if you go to that exam and you're able to read chapter 1 to 3, you're already preparing for 15 marks. Next, you now look at your 30 marks. ICANN also gave us a clue. He said for these 30 marks, students should look at the environment like cost of capital, investments, merger, acquisition, financial statement analysis. Within this topic we have mentioned, examiner will come out with your 30 marks. Now, if you now move away from there, you can't go to that exam without understanding sources of finance. You can't. Because if you try to even define financial management, financial management is defined as an integral part of management that deals with how companies source finance. That means you must know how company can source finance and how company utilize finance to meet the objective of the business entity. In recent time, banks, we now have public offer rights issue. They are trying to source finance. As a finance manager, you must understand the different or the various sources of finance. And remember that all finance comes with a cost. If you are talking of equity financing, there's a cost attached to equity financing. That is the cost of equity. You must now understand how to determine cost of equity. If you are talking of debt financing, then there's a cost of debt. Now you need to understand the different types of debt you can have. Redeemable debt, irredeemable debt, convertible debt, or convertible bond, bond with warranty. Now, how do we determine the cost of these different types of debt? Preference shares. That's why cost of capital is important. If you understand the various types of finance, you must also understand the cost of each finance source. From the definition of financial management, it's an integral part of management that deals with how companies source finance and how to utilize finance to meet the objective of the business entity. Now, let's ask ourselves, how do companies use finance? Company will place finance into investments. When companies source finance, then the company must have a project you want to do with your finance. If I ask the class, why are banks sourcing for finance? Fidelity Bank, they have public offer running, or maybe it's closed, I'm not sure. GT Bank has public offer running. Zenith Bank has public offer and right issue. Why are banks sourcing for finance? Why are these companies using right issue and public offer? Equity financing. There must be a purpose for that money. Banks are trying to meet the regulatory position. Banks has been asked, all commercial banks has been asked to increase their capital base. And they are now trying to source finance to meet the capital base. That means shareholders' funds will increase. What is the risk of increase in shareholders' funds? What is the risk of running a public offer? There could be dilution in ownership. We expect the share price of this company to fall in line with the theoretical S-price theory. You know, at every point in time, we are going to be challenging ourselves. Because the truth is, accountants, we stand in the position of the health officer. We are doctor to firms. The financial health of a company is placed in our shoulder. All right. I wish all the best. May God give us a better understanding. We shall be closing the class on this note. Let's have a blessed evening. Good night. Any question for me?
Thank you, sir.
All right, good night. And remain blessed.
Thank you, sir.